Hey everyone, in this section, let's look at the other tools of monetary policy that will influence the ability of commercial banks to lend money. The second method of conducting monetary policy is the reserve requirement, which is the percentage of each commercial bank's deposits that it is legally required to hold either as cash in their vault or as deposit with the Federal Reserve Bank. Greater reserve requirement, less money available to lend, and vice versa. Now look at these numbers here. We have the reserve ratio, we have the checkable deposits, actual deposits, required reserves, excess reserves. Let's just explain all of them one after the other. The reserve ratios are set by the Federal Reserve Bank or the Federal Reserve System. The checkable deposits are the amount of money the commercial banks hold. I'm just going to write this as C banks. The required reserves part, this comes from the reserve ratio and from the checkable deposits. So I'm just going to try to make them interconnected by drawing these arrows. I have the checkable deposits of 20,000 in the first row and reserve ratio is 10%. The way I calculate required reserves is equal to 10% of checkable deposits, which is equal to 2,000. That's where this 2,000 comes from. Required reserves is something the commercial banks they need to hold with the Federal Reserve Banks. But if we look at the numbers here, looks like instead of holding $2,000, the commercial banks have an actual reserves of $5,000. Now I'm going to calculate the excess reserves, and to calculate excess reserves, I need the difference between actual and required reserves. So let's just use this color, these arrows, to get all these three columns, 3, 4, and 5 interconnected. The excess reserves 3,000 I'm getting by subtracting required reserves from actual reserves. Now the money creating potential of a single bank is 3,000. I need to find the money creating potential of the entire banking system. To be able to know the money creating potential of the entire banking system, I need something called the money multiplier, which is M, and this is equal to 1 over the reserve ratio. This M is the money multiplier. I have the reserve ratio as 10%, which is 1 over 0.10. So this is gonna be equal to 10. Now to find the money creating potential of the entire banking system, I'm just gonna keep this to interconnected. It will be 3,000 times the multiplier, which is 10. So this is 3,000 times 10. This turns out to be 30,000. Okay. I can calculate row 2, 3, and 4 the same way. Just to let everyone know, when this reserve ratio this increases, I'm going to say when the reserve ratio increases, the money creating potential of the banking system decreases. So I'm just going to write here, money creation goes down. Okay, so these two are inversely related. Now look at the third tool of monetary policy, which is the discount rate. The commercial banks may have unexpected and immediate need for cash, and the Federal Reserve Bank is the lender of last resort, and they are going to lend short-term loans to commercial banks in its district. The interest rate the Federal Reserve Bank is going to charge the commercial banks is called the discount rate. Lower the discount rate, the commercial banks will borrow more money from the Federal Reserve Bank, and higher the discount rate, the commercial banks are going to borrow less money from the Federal Reserve Bank. So when the discount rate is lower, money supply in the economy increases. Discount rate is high, money supply in the economy goes down. Now I'm going to look at another tool of monetary policy, which is interest on reserves, and this law started in 2008, where the Federal Reserve Banks can pay interest to commercial banks on excess reserves. Let's look at the two options of the commercial banks. The commercial banks can either deposit its funds with the Federal Reserve Bank, or the commercial banks can lend out money to other commercial banks, businesses, or households. So what will the commercial banks do if it has these two options? Depends on whoever is paying the commercial bank a higher interest rate. So over here, the commercial bank is, or the commercial banks are interested in a higher interest rate because they are getting paid here and they are not paying the money. If the Fed is paying the commercial banks an interest rate of 7%, and this option is paying the commercial banks an interest rate of 5%, then commercial banks would rather deposit their money with the Federal Reserve Banks. And if it does that, the money supply in the economy will go down. If this is the situation here, money supply in the economy will go down. On the other hand, if Fed has an interest rate of 3% and the other option here has an interest rate of still 5%, the commercial banks would rather lend out money rather than deposit money with the Federal Reserve Bank. For the second option, the money supply in the economy will go up. So the interest on reserves, if this increases, money supply is down. If this goes down, money supply goes up. That's all for now. Thank you very much.